Hi and welcome to everybody from the team of Yoursens. Today we will deal with main issues of our project work, and in particular we will start from the choice between sole proprietorship and partnership. Among the different form of business, we believe that to be more competitive and efficient on the market, partnership and in particular general partnership is the best choice. The reasons for our choice derive first of all from the simplicity with which a partnership can be established. In fact, the costs for the creation are relatively low, especially if divided between several partners. A partnership also allows us to make the best use of the qualities and experience of the different partners. And above all, we must remember that this choice helps us in requesting loans and in increasing the value of the equity, also through new partners who bring new financial capital. Moreover, it gives us the possibility of having a business with a larger size in order to have more efficient operations and to have a single taxation. Our choice between general and limited partnership fell on the general one because in the limited partnership, a limited partner has no involvement in day-to-day running of the business. The limited partner is largely an investor in the firm, while a general partner has unlimited liability and is active in managing the partnership. And this aligns with our idea of having all partners
This
actively
is the statement
participating in
of
the
financial
business.
position of Yoursens at the starting point. On this table, you can see that cash is coming from an obligation towards a financial institution, with interest payable after 5 years, but also from our personal wealth, with an investment of 40,000 euro from each one of us. On the left of the table, we have the assets, which are made up of durable factor production, such as the feasibility study, product design, or software, patents, and so on. As regards the non-durable factor production, for example, we have the raw materials that are part of what we have listed in the table under the name of price of production. As we know, in the balance sheet, the total assets are equal to the total liability plus equity. This table shows the revenues and costs of the first year of our firm. This one is the second year, this is the third, this is the fourth, this one represents the last year. At the end of these 5 years, after closing the business and repay all the debts, this is the total income of our firm. As you can see, this represents the capital structure at the beginning, while this one represents it at the end of 5 years. What remains is cash.
Obviously, we reported all the operation of the value change analysis. We know that there are some operation that happens more than one time during the entire lifetime of the firm, like for example, the acquisition of products that will be sold on the market, or even the payment of the employees. There are other operations that happens only one time, like when the firm was established with an initial capital of 200,000 euro. In this case, we have a positive financial change plus cash and even plus equity, so positive economic change. The following month, we received a loan for 285,000 euro that will be paid back the fifth year with an interest payable. And since we are dealing with a debt, we have again an inflow of cash, so positive financial change, but even plus financial debt, so negative financial change. Then there are some operations, like I said before, that repeat themselves, such as the rent of the building, other that happens only one time, like the purchase of the feasibility study. The 1st March 2023, we purchased input for 265,000 euro, the regulation for 53,000 euro. We use the trade payable. We know that we have an outflow of cash, so negative financial change, but since we have even plus trade payable, we have even another negative financial change and a negative economic change, the expenses for the acquisition of durable factor of production. So maybe it is better to run in order to see the last operation, even because there are many operations that repeat themselves in the value change analysis. Even when we sold products for 750,000 euro, plus cash, inflow of cash, positive financial change, and revenues from sales, positive economic change. Talking about the last part of the value change analysis, in this case we know that the firm repays the financial debt in one single solution, the 1st February 2028, increased for the interest payable. So we have less financial debts versus financial institutions, so positive financial change, but even minus cash and outflow of cash, of course, and expenses for the matured interest payable, negative economic change.
In this slide is represented the income statement of the firm for the first and for the second year of activity. Both in the first and in the second year, we expect to have net revenues equal to 750,000 euros. At these revenues, we have to subtract all the expenses, so we obtain then the gross profit, and as you can see, under the value of the gross profit, there are other expenses, that is marketing, sales, and G&A expenses, which include, for example, the salaries of the people who don't work directly on the product, like marketing manager or salespeople. Here is the capital structure of our firm for the first year of activity. What in my opinion is important to notice is that among the assets we also included the net income of the first year. Consequently, net income also appears in the equity section, because as I said previously, we want to reinvest our part of the income in our firm. In this way, the equation assets equal to liabilities plus equity is also respected. In this slide, there is the capital structure for the second year of activity, which is essentially equal to that of the first year. The only variation is that the final values of assets and of liabilities plus equity, which actually increased because net income in the second year also increased.
Non-financial indicators, also known as key performance indicators, are crucial for assessing